So, what is a 2-1 buy down home loan? You're probably hearing about this quite often if you're looking to purchase a property or if you're a real estate agent and thinking, what is this new product? Well, first of all, it is not new at all. It's been around for a very long time. But over the last 10 years, right now I'm recording this in 2022. Over the last 10 years, we really haven't needed any type of reduction in home loan interest rates because rates have been so low on 30-year fixed mortgages. Well, now that it's 2022, at the end of 2022, actually, home loan interest rates have come up really substantially over the last 8 months. And now people are really looking for some relief to their monthly payment. And that's where a 2-1 buy down comes in. But unfortunately, people are pretty much across the board explaining this incorrectly. Okay, so I'm going to show you how to really explain this. I'm going to show you how it really works, basically how this product really works. I'm going to actually bring my screen up and show you a little bit of how we calculate that so you understand that. Now, my name is Brent Bruce. I'm the president of Rancho Capital Home Loans. I'm also the host of the Brent Bruce Daily, where we talk about home loan interest rates each day, whether they went up, whether they went down, why they moved. So we always talk about what's going on with home loan interest rates. But more importantly, I'm a mortgage broker myself. I do these home loans every day. I work with customers every day to find the best product and best payment for them. So I am using this 2-1 buy down product, but I understand how it works, and I'm going to show you how it works right now. If you find this information helpful or interesting, please take a moment and click the little like down below and subscribe so you get more information like this, and share it with anybody else that you think this might be helpful for. So let's dive in. Now, the first thing that you need to understand is that when I'm putting someone into a 2-1 buy down product, the first thing we do is just do a regular qualification. What is your regular interest rate on a 30-year fixed mortgage, for instance? So let's say that you have good credit and good income and good assets, and you're buying a house for $400,000 and you're putting 10% down. So let's take a look and see how that would work. We're going to assume that the interest rate you qualify for and the interest rate that I would offer is 6.99%. That's your regular interest rate, 6.99. Okay. So let's jump over here to my screen. Now, what I do is, this is the exact calculator that I use to tell you how all these numbers are going to work. So let's go in here and let's put in our scenario. So we talked about that our purchase price was $400,000. Our loan amount, remember we said 10% down, which is $40,000. So our loan amount is $360,000. And the interest rate that we're saying is 6.99%. It's a 30-year loan, which means there's 12 payments. So if this was your scenario, the monthly payment, your principal and interest, would be $2,392.67 for 360 months. All right. Now I need to stop right there because this is what I need you to understand. This is what people are not explaining properly. If your interest rate is, for instance, 6.99%, and you use a 2-1 buy down product, your interest rate is not going down. It does not bring down your interest rate. It brings down your payment. Okay, so the way this product works is that the seller of your property, and only works on a sale right now, the seller is prepaying some of your interest. They're prepaying your payment. Let me show you what I'm talking about. So the way that it works is that, you hear it all the time that the first year it's 2% off your interest rate. The second year it's 1% off of your interest rate. That's how it's normally sold. So they sell it like, if 6.99 is your regular rate, well, for the first year, your interest rate is 6.99. I'm sorry, is 4.99. And for the second year, your interest rate is 5.99. And then your interest rate goes up to 6.99. That's not really how it works. Your interest rate is always 6.99. But what they're doing is they're having the seller pay for a portion of your payment. So what they do is, in order, to offer this product, they say, well, if your interest rate was 4.99, what would your payment be? So if your interest rate was 4.99, your payment would be $1,930.36. Okay. What's the difference between the regular payment and the what if payment? So if your interest rate was the 4.99, the difference between these two numbers is $462.31. So if you multiply that by the first 12 months, it equals $5,547.72. So the seller is going to pay this for you. The seller is basically paying. So when your monthly payment comes in the mail and it's $2,392.67, the seller is basically prepaying $462.31 of it for you for the first 12 months. Now, when the second 12 months comes around, it's a smaller amount. They base the payment, the savings amount, on 5.99%, which would make your monthly payment $2,156.07. So the difference between your real payment and your what if payment is $236.60. Multiply that over 12 months, and you get $2,839.20. Okay, so again, the seller has prepaid this amount. How does that work? Well, when you buy your house, you would basically have negotiated in your purchase contract for the seller to pay for a 2-1 buy down for you, prepaid interest. All right. So they would have to pay out, they would have to pay for you at closing $8,386.92 in order for this product to work, in order for you to get a 2-1 buy down. See, what's happening is they're putting this money basically in a little separate account that your bank manages, and they're prepaying your monthly payment. So yes, your monthly payment for the first year would be $1,930.36. And the seller would kick in this amount. And that way, the total amount is paid. Second year, you are paying $2,156.07. The seller is paying $236.60. So to give you a little bit more clarity on this, let's say that you won the lottery and you paid your house off after only 12 months. So 12 months down the road, you go ahead and you pay your house off. Well, this amount wasn't used, right? Because you only used this amount. There was only 12 months. The credit of $462.31, which equals over 12 months, equals $5,547. But the seller credited you $8,386.92. You would actually get this money back. It's your money. The seller gave you $8,386.92. So this amount here would come back to you. It actually would roll over and pay down your principal balance by that amount. But I think that knowing that should help you understand that basically the seller is just prepaying some of your interest for you. Okay. So that is how the 2-1 buy down product works. Now, everything that I've been showing you, this is all a scenario. So you can't take these numbers to the bank as far as, well, my payment's going to be $23.92. I hope you understand that. You have to get qualified to see what this original number is, and then I'll be able to tell you what these other numbers are. So you can always reach out to me. Now, why would you want to do this type of a product? Well, it's especially helpful. Now, right now, of course, people want their monthly payment to be lower. So they're looking into this product. But again, it's only lower for the first year. And then it's only a little bit lower for the second year. And then you go to your regular payment. So if you're not in a position that you could actually make your payment at $2,392.67, you may not want to get into this loan, because one day this might be your payment. But one of the things I'm telling my customers right now is that we do believe that home loan interest rates are going to come down in the next 12 to 24 months. So in 2023 to 2024, we have reason to believe that home loan interest rates are going to come back down. Now, I'm not just saying this as a sales pitch. Go back and watch some of the videos that are on my YouTube channel that talks about why home loans move and how home loans. Matter of fact, there's a whole video on why we think home loan interest rates are going to come down in 2023, 2024. If that was the case, and you had a reduced payment by using a buy down, you had a reduced payment for the first year, and interest rates came down, you could refinance into a lower interest rate, hopefully, and you will have never gotten up to that 6.99% or that whatever that maximum full amount of your real interest rate is. You would never have experienced your full payment because your seller would be supplementing that through a long enough period that you waited until home loan interest rates improved, and then you were able to refinance into that lower interest rate. I know this is a little bit confusing, but I hope that it clarifies that the first year your interest rate is not 4.99 or 5.99. Your interest rate is always the same. It's the seller is prepaying some of your payment for you. So if you want to know more about it, reach out to me, send me a note, look at my bio. There's all kinds of information in there. Make sure that you like, subscribe, and share, and let me know what your thoughts are. Have a great day.